Hi everyone, welcome back. Today we're going to talk about Chapter 22, Accounting Changes and Error Analysis. The key thing to note here in Chapter 22 is we're going to focus on three areas that relate to change in accounting. That is accounting changes that are change in accounting principles, change in accounting estimates, and change in reporting entity. We'll primarily focus our attention on the change in accounting principles and change in accounting estimates. We will also cover the correction of an error, which is different than a change in accounting principle or a change in accounting estimate. One thing to note about this chapter is that this chapter does not have quite as much complex accounting as some of the other chapters we've covered so far in this course. So hopefully that is a little bit of a relief. So this is a little more conceptual in nature of a chapter. There is some accounting that would have to be done computationally, but the majority of this chapter will be conceptual components. Alright, first up, let's talk about change in accounting principles. This involves changing from one generally accepted accounting principle to another generally accepted accounting principle. That is, from one GAAP accounting principle to another. One key thing to note here is that it's only appropriate for a company to make a change in accounting principle when it can demonstrate that the alternative principle they're going to use is preferable to the existing one. An example of this change in accounting principle is a company switching from measuring inventory under the LIFO method to the average cost method. So this is where a company would determine that historically they have always valued their inventory or measured their inventory under one accounting method and decided that moving forward that they would like to change and use an alternative measurement method. One very important thing to note, and this is not to confuse you with a change in accounting principle versus a new accounting principle. So under these circumstances, a change is not considered a change in accounting principle. The new principle is adopted in recognition of events that have occurred for the first time or that were previously immaterial. Sorry, I'm going to switch views here for just a second. Okay. Okay, so the key thing here is to take away from this is that if you were using a principle for the first time, it's not a change in accounting principle. Or also, if you're using it for the first time because it perhaps was immaterial previously, that is also not considered a change in accounting principle. So you can see there's an example there that historically you have not capitalized your leases because they were not material to your business. However, you have elected to begin capitalizing your leases. This is not considered a change in accounting principle because they were previously immaterial, and now the company, since they are becoming material, has elected to apply the accounting principle of capitalization. Next up, we're going to talk about the difference between a correction of an error and a change in accounting principle. This is very important to understand the difference between these two. So if an accounting principle previously followed was not acceptable, or if that a principle was applied incorrectly, a change to an accounting principle is considered a correction of error. To put this into, I guess there's an example there, but in generic terms is that if you weren't doing what you were supposed to originally and then you go back and correct it, it is not a change in accounting principle. So if you weren't using a principle that was acceptable under GAAP, then you were doing your accounting completely wrong and you need to correct it. Therefore, the correction of an error. Even though you may be changing accounting principles, because of this, it is not deemed a change in accounting principle because it was an error and you were using a non-acceptable accounting principle, or you were applying an accounting principle incorrectly. So for example, in year 1, Company A capitalizes research and development costs. Under GAAP, these costs are not allowed to be capitalized and should be expensed as incurred. Therefore, in year 2, the company changes their accounting to expense these costs as incurred and no longer capitalizes them. This would be considered a correction of an error because they were applying an accounting principle that was not acceptable or was applying it incorrectly, and therefore in the second year when they made the change, it is merely just a correction of an error. There are 3 approaches that exist with regards to change in accounting principles. One would be reporting the changes currently, so you just report an impact to the current year only. B would be that you report the changes prospectively, which means going forward. You would just apply the new principle in the current year and then every year subsequent. And the last one is changes retrospectively. FASB requires companies to report changes in accounting principles under the retrospective approach. What this essentially means is that the company has to go back to their prior year financial statements and correct them as if this new principle had been used for the entire time. We'll talk a little bit more in detail on the specifics of that, but that's just kind of the basics. So the main reason the FASB requires this approach is because it provides the financial statement users with more useful information. Because if you change the prior year numbers to be on the same basis as the new year adopted accounting principle, the results are more consistent and comparable across the different accounting periods. Therefore, if you make a change in 2016 and the company has to go back and make changes to 2014 and 2015, when you see comparative financial statements that may have 3 years of balance sheets for 2014, 2015, and 2016, all 3 would be accounting with the accounting principle, the new accounting principle, under the same method. So it increases comparability. We are not going to focus much, or actually at all, on the other 2 approaches for a change in accounting principles, since FASB requires the retrospective approach. This is where we are going to focus our attention. The retrospective approach. So this requires prior year statements to be restated as if the new principle had always been used, and the cumulative effect of the change is an adjustment to beginning retained earnings of the earliest year presented. Under the retrospective approach, these are the 3 main procedures that are performed. You adjust the financial statements for the prior period presented to reflect this new accounting principle. You adjust the carrying amounts of assets and liabilities as of the beginning of the first year presented on the financial statements. And you will make an offsetting adjustment to the opening balance of retained earnings as of the beginning of the first year presented. While there are all 3 of these steps that need to be considered, we will focus our attention on an adjustment to retained earnings. We will not focus our attention on the carrying amounts of assets and liabilities and correcting those. Specifically, I just want to show you how to look at what the retained balance change to retained earning will be. So, in your packet, there is an example here. So, Jayhawk's company began operations in January 2014. At the beginning of 2016, the company decided to change from the LIFO method of determining cost of goods sold to the FIFO method. So from last in, first out method to the first in, first out method. The company has a tax rate of 30%, and I presented you what the cost of goods sold expenses were for each year presented for the financials under each method. So as you can see, there is a difference in each year in what is reported under each method. So there's a couple questions for you here. One, how much cost of goods sold should they record in 2016? And then two, what is the amount of the adjustment needed to retained earnings to account for the change in this accounting principle? And then did that increase or decrease retained earnings? So step one, which will address question one, determine the cost of goods sold to be recorded during the current year. This is going to be $850,000. And the reason for this is at the beginning of 2016, they changed their accounting principle to the FIFO method. Therefore, the entire year of 2016 was under the new accounting principle. Therefore, you would only reflect the expense under the new accounting principle in the current year. The next step is you need to determine what the pre-tax adjustment needed to retained earnings is to reflect this new principle. And as a tip, again, reminder, you need to use the retrospective approach. So for this step, you'll need to compare the difference between what was booked, the LIFO, versus what should have been booked under the new accounting principle in the previous years. Since we just answered what the current year entry to cost of goods sold is $850, and that is under the new accounting principle, we do not need to adjust any of that balance for retained earnings. However, since 2014 and 2015 were different, we need to adjust the retained earnings to account for those changes. So first, it's simple as just figure out what was booked in those periods, so 1.5 million under the old method. Under the new method, you booked 1.43 million. Therefore, your cost of goods sold under the new method, under the FIFO method, is $70,000 less than what it was under the LIFO method. Therefore, the expense incurred should be less when you're factoring retained earnings. This is very, very important. You will need to understand this concept right here. This is how you will answer the question of whether or not debt retained earnings will increase or decrease based on the impact to retained earnings and the difference between the old method and the new method. Okay, so if your cost of goods sold under the new principle is greater than the old accounting principle, you would decrease retained earnings. This represents that the new principle required more expense, and therefore more expense means less income, which means less net income that is pulled into retained earnings at the end of each year. Our example is the second bullet point here. So if cost of goods sold under the new accounting principle is less than the old accounting principle, this will increase retained earnings because this represents that the new accounting principle required less expense than the old one. So make sure you understand that, and I hope that makes sense, as it's really a comparison of looking at which principle gave you more or less expense, and then determining how that's going to change retained earnings. And just think of it as if you expensed too much, your retained earnings is going to come down because, if you expensed too much under the old method, then your retained earnings is going to increase because that means that you expensed too much, therefore your income was not as high as it would have been under the new principle. So first you need to determine what the pre-tax adjustment is to retained earnings. So the pre-tax adjustment is going to be this change up here that the 70,000 that we just calculated. Then the post-tax adjustment needed to retain earnings. Since your net income is taxed, your profit and expenses, when you get to your net number, it is taxed, and that number is then pulled into retained earnings. Therefore, you need to reflect the amount left over after tax that's going to adjust retained earnings. Since the prior balances in previous years that were pulled into retained earnings were net of tax, you have to do the same here. So you take the $70,000 change times 70%, which represents 100% minus the 30% tax rate, and that equals 49,000. This will be the computational part of this chapter with regards to change in accounting principle. So if you can understand this setup, and I think for most of your problems I'm not going to change it too much in sense that it will probably be LIFO and FIFO method. I'm not going to try to confuse you. It will be very similar to this kind of problem for your homework and your exam. So if you understand this concept of determining the difference, what should have been higher or less, and then how this part right here adjust retained earnings, you should be able to get the computational problems with no problem for this section. When you make a change in accounting principle, there are a lot of disclosures that go along with this. I have put a few of the things just to give you an idea. The main thing I want to point out is you have to describe the nature and reason for the change and any explanation why it is preferable. What this does is this makes the company accountable for explaining why the new accounting principle is better than previous accounting principles. And what it does is it puts a little bit of responsibility on the company to not sit there and every year just flip-flop back and forth to what makes their financials look better. You will also, when applying the retrospective method, you'll need a description of the prior period information that was adjusted, the effect of the change on income, and the cumulative effect of the change on retained earnings. You just need to understand this from a conceptual standpoint. You will not be required to apply any of these in a disclosure format or anything like that. When you make a change in accounting principle, there are direct and indirect effects to the company's financials. Direct effects should be presented retrospectively. Therefore, they are presented similarly to how you just did the change in accounting principle. As an example, an adjustment to an inventory balance as a result of the change in the inventory valuation method. As we talked about in our very first example when describing change in accounting principle, where the company changed from a LIFO measurement to an average cost measurement, this would be an example of a direct effect. Therefore, they need to adjust their inventory balance on a retrospective basis, which, if you remember from the section on the 3 steps of things you need to change, the balance to the assets and liabilities is one of them, and therefore that is where the direct effect ties in. Indirect effects are not shown retrospectively, but they are reported in the current period only. Make sure you understand that direct effects are treated retrospectively, similar to the rest of the change in accounting principles, and indirect effects are current period only. An example of an indirect effect is the change in profit sharing that is based on the reported amount of revenue. Therefore, because you changed your inventory valuation method, there may be a change to the company's profit sharing because the amount of reported revenue is going to be impacted. How to count for impractical changes. There are certain times when the company should not use the retrospective approach when making a change in accounting principle. There are 3 bullet points there. 1, the company cannot determine the effects of the retrospective application. 2, the retrospective application requires assumptions about management's intent in a prior period. And 3rd, the company cannot objectively verify the necessary information to develop any estimates for a prior period under the retrospective approach. I would say, from my personal experience and practice, most companies are able to use the retrospective application. It's not frequent that they cannot figure out this information and be able to apply it. Therefore, if you company determines that it is impractical to apply the change in accounting principle as retrospective, they would apply it under the prospective approach. But if they do this, additional disclosures are required to detail why they are doing this approach and that the approach that they're taking. All right, moving on. We're going to now talk about change in accounting estimates. And so it is important to understand what the difference between a change in accounting principle is and in a change in accounting estimate. A change in accounting estimate occurs as a result of new information or additional experience when the company uses this information to adjust an accounting estimate. There's a difference between an accounting estimate and an accounting principle. For example, some things that are reflected as a change in accounting estimate include uncollectible receivables, useful lives, and salvage values of assets. So as an example, when you have receivables, you have to make an allowance for bad debt account, and the company has to estimate the percentage of their accounts receivable that they do not believe they will be collected. That is an example of an accounting estimate. They have to use judgment and come up with criteria and explain this estimate in their financial statements. There is an example provided there. Company A has been in business for over 50 years and has always estimated the useful life of their depreciable assets to be 10 years. During the current year, the company's review of historical data and improvements in the production of the depreciable assets indicated that their depreciable assets had estimated useful lives closer to 15 years. Therefore, the company elected to switch from estimating the useful lives of using 10 years to 15 years. That would be considered a change in accounting estimate. Careful estimates that later proved to be incorrect should be considered change in accounting estimates, not errors. So for example, if a company comes up with an estimate for their allowance for doubtful accounts at 2% of accounts receivable, they detailed it out, they had rationale why they did it, but that turns to be completely wrong, and looking back in hindsight, they probably should have booked like 25% uncollectible. That is not considered an error. Even though it was a substantial difference in change in the estimate, is not considered an accounting error that they made a estimate so low. The big difference between a change in accounting estimate and a change in accounting principle: change in accounting estimates are reported prospectively. Therefore, they are only adjusted in the current year going forward. You do not have to go back and restate prior financial statement balances. So, as an example, on January 1st, 2006, ABC Company purchased a $300,000 building and originally estimated that it had a useful life of 15 years, in which depreciation was recorded on a straight line basis of $20,000 per year. That, to get to that number, because you may have to calculate this balance, To get to 20,000 year depreciation, it is simply 300,000 divided by the 15-year useful life. Assume that there is no salvage in this example. On January 1st, 2011, the company revises their estimate of their useful life and now considers the building to have a remaining useful life of 20 years. Make sure it is important that you take note of that I use the word remaining. You could see a problem where it says that the building would have a total useful life of 20 years. So in this example, you are going to use 20 additional years as the new estimate. However, if I would have said it had a total useful life of 20 years, the years that you would be using in your change in estimate would actually be 15, because 5 years have already passed. So that is, make sure you understand that. The difference between what's left in a total number and what's remaining. So your first step is you need to calculate what the book value of the building was at the time of the change in estimate. So 300,000 minus 5 years of depreciation, so that is 2006, 7, 8, 9, and 10, because we made our change on January 1st, 2011. And that gives us a book value at the time of the change in estimate on January 1, 2011 of $200,000. Now, since we applied the change prospectively, we need to figure out what the new depreciation expense is going to be each period. So we can answer the question of how much depreciation expense should they record in 2011. All you have to do is just take your new book value you just calculated and divide it by the remaining service life of 20 years. Therefore, that gives you $10,000 per year depreciation expense, and so that is what is recorded on the income statement. So essentially, this I don't think is too complex. I think the main thing to make sure you understand is the remaining service life versus the total service life. Under certain circumstances, it is impossible to tell whether an accounting change is considered a change in estimate or a change in accounting principle. If this occurred, the company reports this as a change in estimate affected by a change in accounting principle. You may also see this referred to as a change in estimate inseparable from a change in accounting principle. You do not need to understand any calculations or anything with this. Just know that if you can't distinguish between the two, this is how it is reported. For disclosures of change in estimates, in contrast to change in accounting principles, which require significant disclosures, they normally do not need to be disclosed unless it is a material change. For example, when I talked previously about a company changing their allowance or doubtful account percentage from, say, 2% to 25%, that would probably be considered a material change in estimate, and therefore the company would most likely disclose some information about that in their financials. Next, we're going to move on to change in reporting entity, and this we'll be very brief with. This is simply when a company changes from reporting as one type of entity to another type of entity. The most common one to think of would be a company presenting consolidated financial statements in the place of individual financial statements for its companies and subs. You would change the financial statements for all prior years presented to reflect the new reporting entity. So if I was presenting 2 years of financials on my balance sheet and I had reported every company individually, then I consolidated them, I need to show both the current year numbers consolidated and the prior year numbers consolidated, even though the prior year numbers were not shown consolidated previously. Next, we're going to focus on errors in the financial statement. As we mentioned previously, there is a difference between a correction of an error and a change in accounting principle. An error in the financial statement is something that results from mathematical mistakes, mistakes in applying accounting principles, or oversight or misuse of facts that existed when preparing the financial statements. One key thing to note, an error correction does require a change in accounting, but it is not classified as an accounting change. The three accounting changes that we have discussed previously, the change in reporting entity, change in estimate, and change in accounting principle, those are the three accounting changes. An error correction, while you do change balances, is not classified as an accounting change. It is classified as a correction of an error. You will record and report prior period adjustments for accounting for correction of errors. For example, when reviewing the depreciation entries for 2014 through 2016, the controller at Log Inc. found that in 2015, the depreciation expense was incorrectly debited for $750,000 when it should have been debited for $900,000. The tax rate is 30%. What is the adjustment needed to retained earnings to reflect the correction of an error, and does this increase or decrease retained earnings? Similar to accounting for accounting for change in accounting principle, we're going to focus on the retained earnings impact in a correction of an error example. First, you need to determine what the pre-tax adjustment needed. So that is very similar to change in accounting principle. You just need to determine what was booked versus what should have been booked. So we booked $750,000 in 2015. That was wrong. We should have booked $900,000. Therefore, we have a $150,000 difference. Since the balance that should have been booked is greater, this means that we did not record enough expense during 2015. This is exactly similar to what we talked about in change for accounting principle. The difference in the change in retained earnings, whether it increases or decreases, depends on if the expense was too much or too little. So in this example, we did not record enough expense. Therefore, our retained earnings is too high because our net income was too high when we pulled it into retained earnings. So now then you determine the post-tax adjustment number. So 150,000 times the 70%, which is 100% times the 30% tax rate, and that gives you $105,000. Since the company did not book enough expense, a debit entry is needed to reduce retained earnings. And this represents the fact that the company's expenses were understated. Therefore, the net income booked to retained earnings was too high. Hopefully that makes sense. And the difference between what is a change in accounting principle versus a change in estimate versus an error correction. That is pretty much it for the specifics on the change in accounting principles. The next few things are just a few bullet points on just motivations for changing of accounting method, and this is why a company would change their accounting, either principles, estimates, reporting entities. You can see like political costs, the capital structure with their ratios, bonus payments, smooth out earnings to avoid attention, various things like that. And then lastly, there are error analysis. This is essentially, there are two types of errors. There are counterbalancing errors and non-counterbalancing. The main thing to note is that counterbalancing errors are those that will be offset or corrected over two periods, so the current year and the prior year, or the current year and the subsequent year. And non-counterbalancing errors are those that take longer than two periods to correct or never correct themselves. You just need to know that at a very high level is that counterbalancing are ones that will correct over two periods. Non-countering are one that take more than 2 or never correct themselves at all. You'll see at the end of this handout, the lecture handout, there's a table here that summarizes the topics that we covered today. This is going to be very helpful when you're trying to understand the conceptual components of the differences between these two, between all 4 of these type of changes. So I definitely encourage you to make sure you understand what's in this table. This is essentially a summary of what is previously stated in the or is previously stated in this lecture. That is all for chapter 22. The next chapter focuses on the statement of cash flows, which will have a little more computational components to it. However, this chapter definitely, I think, focuses more on the conceptual, so making sure you understand that. You will, on your homework, have examples similar to what we just did in the handout on change in accounting principles and the change in estimates and correction of an error. So plan on those, but definitely make sure you understand the conceptual components of this chapter, including the key differences between a change in accounting principle, a change in accounting estimate, and a correction of an error, and making sure you can distinguish between those. Well, that is all for this chapter. Thank you again for listening. Your chapter 22 homework and quiz and the lecture handout packet and all of that will be posted for you just after we take the second exam. And the key thing to note with this next set of chapters 22 and 23, you will take a third exam over this material, and then about a week later we'll have the final exam, which will encompass all of the class. So when you're completing your assignments for this chapter, I would take that into consideration, that if you are able to get them done maybe earlier, it would provide you more time to study for the third exam, but not only that, but also time to get started studying for your final. I will provide an exam review sheet for this third test with these 2 chapters, and I will also be providing you a final exam review sheet to help you focus your attention in the chapters that we've covered throughout this course, so you don't have to there's certain things that you won't have to make sure you know, or certain things that you definitely need to make sure you know for the final. So that is all for today. Have a good day.